All right, then take it away.
So there we go. All right. Well, thank you everyone for jumping in here. We're excited to present this to you guys. We're with a company called Westpac Wealth Partners. What we do is we work with privately held business owners and personal clients on really creating the best system of financial decisions around your own personal finances and around your own business finances. So that's what we do for a living. Specifically, what we're talking about today is with regards to your own business and your succession plan of that business and some of the tax and retirement considerations that we see very, very often. So I'm joined today by Brennan Drew. He's vice president here at Westpac Wealth Partners and a certified exit planner. So an absolute expert when it comes to the transition of business, whether that be through an inside sale, an outside sale, or just sort of how to ride off into the sunset until you shut the lights off, as well as Donovan Thiessen, who is sort of one of the premier CPAs and tax strategists here in Las Vegas. So between the three of us, we've got 50 plus years of experience in dealing specifically with small privately held businesses and some of the challenges and opportunities that exist because of your status as a business owner. So really, when we're looking at financial planning for businesses, really at the end of the day, what it is that we're looking at is how do we leverage the business for your own personal financial gain, and how do you leverage your own personal finances for the business's gain? And that line is very, very blurred. It's sort of this gray area of what is mine, what is the business's, and a lot of times in traditional planning, there really isn't a lot of intentionality around how to avoid the most taxes legally, how to increase the value of your business the most and prepare for a sale. And so what we want to share with you guys today is just a couple of thoughts and some common themes that we see, both good and bad, with the business owners that we see. Especially in service businesses like an architect, like construction, where really a lot of the value of the business is with the owner, right? A lot of times your guys' names are the ones that are hanging on the shingle. And so what we really want to do today is we want to talk about different themes that we see, different opportunities that exist within creating and understanding the valuation of your own business, understanding what the plan is, right? Good, bad, or indifferent. You guys are all going to leave your businesses at some point in time, whether you're choosing that, the economy's choosing that, or Mother Nature's choosing that. We don't always get to decide. So having a very deliberate plan of attack on what do I want to have happen? What is that? What does the future actually mean for me? And then what we want to do is just provide you guys with some updates on the tax environment. Because if you've paid any attention to the news recently, there has a lot of pending legislation, and so Donovan's really going to dive into some of the important tax considerations for you guys going forward. And really, what we want to provide too, as well, is at the end of this, we want to provide an opportunity for you guys to be able to ask questions and sort of pick our brains a little bit if there's anything that's super top of mind. When we talk about business valuation, it really is the starting point for any intentional exit strategy, succession planning. So I really want to tap into Brennan's expertise here. Brennan, as a certified exit planner, you're dealing with dozens and hundreds of business owners on an annual basis. Can you talk a little bit about what your experience is and what that means, what business valuation really means, both your perspective and what a lot of common themes are you see with business owners and how they view their valuation, and just why that number is so important for us to really hone in on?
Yeah, absolutely. Can you hear me okay? Just clarifying that I'm coming through all right. Cool. Yeah, so business valuation, I think, is something that is dramatically overlooked when I'm meeting with business owners for kind of our initial consultation. A lot of times when those initial discussions, when you ask them about how much they think they could get for their business, or if they've ever done any sort of valuation. It's just kind of like a rule of thumb, industry standard type approach that they have a number in their head that they think that they can get. And the reality is, for most business owners, the business is their biggest asset. That's like what is kind of making their life move forward, and what they've put a lot of their eggs into that basket per se. So with and not having a true accurate mathematical understanding of that valuation, it really is kind of hard to come up with processes or come up with strategies, or even know whether you're growing the valuation or ultimately hurting the valuation. So to me, business valuation is like the first place that I start with any business owner, because we really want to get a true metric and true understanding, kind of bring some reality and identify the expectations to the owner when we use a mathematical approach to valuing the business. Now, there's a lot of different types. We can get into whether it's an asset or income or market approach. There's different ways to value the business. But I think that all too often people are overlooking it, or just kind of using some back of the napkin math to assume what their business is worth.
Yeah, Brendan, you sort of talk about this like back of the napkin math, or I think the common theme, like we said, just there's not really a very intentional approach to understanding exactly what this asset means on an owner's balance sheet. Usually, in your experience, and correct me if I'm wrong, you're normally seeing the value of a business being one of the largest assets on an owner's balance sheet, if not the most valuable asset. So for there not to be a very intentional approach to that number, can you talk about a lot of things that you hear owners telling you, and for a lot of times it's well intentioned, like they're trying to do the right thing for their business. Can you sort of talk through some common pitfalls or things that you see that owners are they might think they're doing something the right way to help their value of their business, but they're actually hurting it?
Yeah, absolutely. So like you can see there on the screen, as owners of companies, usually they're type A personalities, right? It's like they're very optimistic people. This business is their baby. They've grown it from its infancy to where it is now, and they're just kind of like, hey, let's roll up our sleeves and get things done, because that's why they're in the position that they're in, right? From the get-go, that's kind of what they had to do to build it to this point. And unfortunately, a lot of those things that they maybe executed on in the early stages of their business that made their business kind of grow and really get traction and move into that growth mode are some of the biggest detriments that you see in those later years when it comes to creating a valuation or around the business and what the ultimate number is going to be. That first example there is probably the most common that I see. Is the business really is the owner. Like the owner takes it upon themselves to wear 50 different hats, and they haven't maybe delegated or created systems and processes where other people can take the reins on some things. And if your entire business model is everything goes through me, I'm kind of the linchpin to all decisions and the linchpin to things getting done on a granular level, the reality is that that's going to hurt your business dramatically. So, if you're going to be the one to get it done, if somebody were to buy your business, that means that they have to go find somebody to now get that thing done, versus do I want my business to have this capability, whatever that might be? How can I create systems and processes with either people on my team or in my company already, or maybe hire somebody outside to make this part of my business model, but not necessarily something that the owner themselves has to do. That truly is one of the biggest pitfalls when it comes to the overall valuation, is just simply that the owner tries to kind of do it all. Hold on, let's stay there for a second. So the multiple buyers, I run into this all the time. I'm working with a couple companies right now, and I literally had somebody say this to me last week in my office. Like, I'm just looking for that one person who values my company. And the reality is that that's an extremely difficult thing to find, unless you've been approached by a competitor in your market or maybe in some other markets. It's not very easy. That's like a needle in a haystack trying to find that one buyer. And even if you have one buyer, it usually doesn't result in the greatest value of the company. You want to create a business or go into your business succession planning or business exit planning, creating multiple potential buyers, because obviously competition is going to help drive the price of your company. So the idea of having one person or one company be the one that buys you, and that being the only prospect, is typically the business doesn't get the full value, because they're kind of up against the ropes and at the mercy of whatever the buyer says they're willing to pay for it.
Yeah,
Cool.
Brennan, I think that's a really interesting point that you just brought up, because I think a lot of times what you see, and correct me if I'm wrong, is you see the majority of people kind of using hope as a strategy. Like, I hope I can sell this for what I think it's worth in the future, or I hope that nothing goes wrong. And I'm excited to hear some of the examples that you might have around this. But that's not exactly how life works, right? The businesses are cyclical. The economy is cyclical. There's really good times. There's really bad times. And if you're working constantly in the business, you're not necessarily working on your business. So can you touch what it really means to work on your business with regards to exit planning, and maybe talk through some of the common, we call them what if scenarios, but like, have you planned for X? Have you planned for the bad day?
That's a great point, Don. I tell every business owner, you're leaving this thing one of two ways: nose up or toes up. Hopefully it's not toes up. We never want that to be the scenario. But like you alluded to in your introduction, there's kind of two main, unless you're just gonna, do it until you die. There's two other doors that you can essentially walk through, which is a insider transaction, where you're selling to a key employee group or family member or partner, other business owner, key executive, or a third party sale, where you're selling on the outside market. There's another person coming in to acquire you. And I really think it's important for people to kind of plan with the end in mind. I'm not saying in the infancy of a business, exactly how you're going to exit, but after, a few years, maybe a decade of being in practice, you probably have an idea of like which direction you would probably like to go, and putting systems, processes, and procedures in order to execute on that, and having that vision and knowing kind of the roadmap to make that happen, is something that I find very, very few people are doing. Like you said, most people are they're so busy with the day-to-day of working in their business that they get bogged down with life. And it's more of just a hope and a prayer strategy of, hey, I want to retire when I'm 60 or 65 or 55 or whatever, they want to get out of the business. They just kind of are like, okay, I think it's going to happen in 2 years. What do I do? And at that point, I'm not saying that you can't sell or that you're not going to be able to sell your business. It's just probably not going to be the most efficient to get the top dollar for your business, because a lot of times if you don't put a lot of hard work into building this plan, into creating this sort of succession plan where the people who are buying your company have a clear-cut understanding of what the processes and the procedures are and who does what, it will dramatically lower the overall value of the company. And that's the last thing you want to see somebody do is, the blood, sweat, and tears, their hopes and dreams that they put into this thing for however many years of their life, not get the true, what I would consider potential value out of the business that they can.
Yeah, and you mentioned that you said the people that are going to take over your business, the people. I think if you ask most business owners, they sort of think it's going to be someone that they don't know that's going to come in and buy their business. But one of the things that I think is interesting, and you can provide some insight on, is the people that are already there, the people that already work in that business, and especially in a service-based industry where you're not selling equipment, you're not selling intellectual property, you're not selling anything really other than yourself and your reputation. Can you talk about specifically transferring your business to someone who you know and you trust and you think is going to be able to keep steering the ship even when you're no longer on the boat?
Yeah. Oh, yeah. It's the reality is statistically 99% of small businesses will never be sold on the open market. Just simply it's not Amazon, it's not Google. Like there's a lack of demand and marketability for most small businesses. That's not my opinion. That's the Small Business Administration saying that. So as most businesses, especially small businesses, where we see successful transfers, involve a key employee group. Now, key employees could be children, it could be a partner. I don't want to just think that it has to be like an executive team, but I'm going to use key employee as kind of an all-encompassing term. But if identified early enough that this is going to be the strategy that somebody wants to take over a 5-year period, 5 to 10 year period, let's say, it can be an extremely powerful tool in order for the owner to get what they believe in, what the fair market value of their company is, and still see what they created over their lifetime kind of be passed on in their image and with the same culture and everything that they had created that entire time. So it really comes down to aligning this key employees group or person, goals and vision and what they want to have happen in their life. Because how often are owners getting approached by their executives or by their top salesperson saying, hey, I want some ownership. Like they want to have skin in the game. And all too often an owner's just like, okay, yeah, you've done a good job. Okay, we'll basically give you 5% or something for all your hard work. And that's really more of a Band-Aid approach. We want to create incentive plans that really lay out the roadmap for both the owner, the current owner, and the future buyer. Because when those two people are aligned and understand what they're doing with, like it says on there, some of these like metric based skin in the game style plans for the buyer to ultimately take over from the owner, and how the owner sees that kind of growing the value of the company and what they're ultimately going to get at the end of the rainbow, it creates not only a symbiotic relationship but it makes everything extremely transparent, and you don't see your best people getting poached and leaving to other places because they have the roadmap to what ultimately is going to happen in taking over the company.
Yeah. And I think that it's one of those things that like people don't think about until they're sort of educated around the possibilities that exist. Talking about the possibility.
To that point, Don, like a lot of times people look at it like, hey, my key employees, they don't have enough money. You know, my business is worth $4 million or 10 million bucks or whatever it is. Like they don't have that kind of money to be able to, you know, write me a check for 4 million or 10 million, which is probably true. However, through planning, you can definitely put some processes and some systems in place that you can get the fair market value of your company over time, and your employees are the ones that are still taking it over. Because I think the people look at the transaction as like, oh, you know, my partner doesn't have $5 million in his bank account to write me right now. Like if he can't do that, how do I sell the business to him? And that's a common misconception.
Yeah, absolutely. And a great point. So let's make this real for people. Let's make this something that is, okay, I have this business. I've never been intentional about knowing what my valuation is or increasing my value or what my succession plan is. Can you talk through, hey, here's a couple of things to do, or maybe a couple of things not to be doing right now? So some tangible takeaways from what we're talking about here.
Yeah, absolutely. So I know on that first slide, it said, we'll give you three, I don't know.
3 ways to increase your value.
3 ways to increase the value of your business. So this is called deal killers. That's a bad way of framing it. I'm going to be optimistic here. I'm going to look at this as these are 6 ways, double your money for, how to increase the value of your business. And the most common things that I see people doing or implementing that will have a direct correlation with growing the value of your company. So incentive planning to keep management around. A lot of times people only have like their group benefits, right? It's like I offer a 401k, health insurance, you know, vision, whatever, you know, they have their little group benefit package, but this key employee group, like the people who ultimately could be groomed to take over the company, they can have plans on top of that. They can have performance-based metrics that when they perform, it's going to directly affect the EBITDA of your company so you're both aligned. And that ultimately that can then translate into into some sort of exit. So incentive planning is huge for your top performers, the people who are driving the EBITDA of your company. Strong sales team besides the owner. I'm not gonna keep hammering this, but again, like too many times, the owner is the only person who has the relationship with the top 15 clients of the firm. And if that owner is gone, then those relationships are completely, let's just say maybe not on the best terms. Processes and procedures in place. Most companies have processes and procedures, but are they documented? Are they written down? Is it part of that written succession plan that was mentioned earlier, where what would happen, who is responsible for what? And it doesn't necessarily, yes, like you're going to address death, disability, you know, incapacitation, that sort of stuff in that kind of a plan. But if it should just be outlined and written for when the owner is still alive, breathing, and well, and what business day in and day out looks like. Those processes and procedures, that is what an incoming buyer, especially in a third party sale, is going to want to see. Like they're going to want to see that when I buy this, everybody knows what their job is, and I can have something that says what their job is. And the people who are important, those top performers, that management, there's a plan so that they're not going to just dip out as soon as I buy this company. They're not going to just, the national firm's buying us, I'm going to start putting my resume out and looking somewhere else. Outside advisors, obviously you want to have a team approach. Not visualizing the future of the business. This goes back to like starting with the end in mind. Like you need what do you want it to be? That's the beautiful thing about being an entrepreneur, is you get to pick your path, and not that you have to know the exact path, or I know I'm transferring it to these 3 people, or I have 3 kids. I don't know if one will take over or all 3 will take over, but at least having an outline and an idea of how you want to do that is extremely important. And then, yeah, you want to know what that end game is ultimately going to look like, how that actually is going to be facilitated. So I would say if you take 3 of those 6 and are able to implement them over the next, 2 to 3 years, you're going to dramatically grow the value of your company. And when I say value, I'm sure a lot of the people on this have heard the term, even, or are familiar with that. I've seen companies where one company, they have the equivalent EBITDA, but one company sells for a much larger multiplier on that EBITDA because they have some of these things in place. So it's not just purely EBITDA that is driving, the value of your company. It's what ultimately is going to be the multiplier on that. And a lot of these 6 things can definitely help affect that multiplier.
Yeah, and that's a awesome point. There's a saying that I love. It says, when's the best time to plant a tree? And most people are like, well, like now. Well, no, it's actually 10 years ago, because now you actually have a tree that is blooming. And I think it's the same thing with this, right? Like, if you haven't done some of this planning 10 years ago, the second best time to ever do it is today. It's right now. Right? Because time is not our friend when it comes to selling a business, right? The earlier we get started, the more success we have. And when it comes to success, I think selling the business is one thing. But I think the other thing is, I think we're all very patriotic here, and we all love our country, but not paying the most amount of taxes is usually something that's on the front of most business owners' list. If I'm trying to get a business owner excited about financial planning, I talk about tax reduction, because August or October 15th, a lot of people probably just stroked very large checks to the IRS. And when we get into some of this more in detail tax planning, I want to switch gears over here to Donovan to sort of go into, maybe some things that business owners either aren't aware of, some pending legislation that might be changing, or some common opportunities, right? Because taxes aren't always a bad thing. Sometimes there's opportunities to engage in future tax strategy. And when I say strategy, I don't mean just cleaning up the mess that the business owner made when it's time to file taxes. I mean, really taking an intentional look at, there are some ways to increase your bottom line by taking advantage of some tax code. And so, Donovan, do you mind touching a little bit on sort of what the future might look like here, and some opportunities that might exist with regards to tax planning?
Yeah. Hi, Don. Yes, absolutely. And I want to just say right up, I'm going to say a few things, and I'll talk about a few things that may not be a bullet point in some of these slides, but it's something that seems to be like highly pertinent for where we're at right now with the tax code, where we're at in time of the year. And what I want to do is I want to start by saying that in 2018, the Tax Cut and Jobs Act was passed. Some people call it the Trump tax reform. And that really changed a lot of elements from the entity levels to the individual levels. It really flipped the way the forms look, the organization of the schedules within the forms. I'm talking about the federal income tax forms, 1040, 1065, 1120S, the partnership and S Corp business tax returns. And so if nothing else changes, the Tax Cut and Jobs Act, most of the provisions in there will expire in 2025. So we're currently in 2022, the year's about over. And so some of the things that we'll be talking about are set to expire in 2025. And within obviously with COVID, there was a number of tax law changes that affected 2020, 2021, 2022. More recently, we got through, they just passed the Inflation Reduction Act, which passed in July and August. I'm going to touch on a few things here for this slide that pertain to that. But on top of that, there's regulations that have been passed. There's proposed legislation that's still hanging out there with various statuses. So it's complicated. There's a lot of moving parts here, and a lot of the things that are included in the next couple of slides, it's just too deep to go into detail on a lot of the stuff. So I'm trying to cherry pick the stuff that I think is going to be most relative for my clients and prospective clients and, you know, the audience that we have here today. So what I want to do is I'll talk a little bit about the items on this slide, and basically if there's any, like on the second item there, the research and experimentation expenses for a business, there are two types of, there's what's called R&D tax credit, and then there's research and experimentation expenses, both of which are involved in like scientific advancements of the company or the products that they're using. There's a couple of, you know, there's like a 4-part test that you have to achieve where we can show that the hours and wages that you're paying are going towards these efforts, that there's a scientific and measurable effort behind it. I say that I think the reality is when you do the studies on these R&D tax credits in this particular item, some of the experts are saying that it's a little more flexible than you might think, but certainly like a scientific process. So engineering, manufacturing, things like that typically fall into that category. But what they've done now is instead of amortizing the expenses over the expected useful life of the asset, they're now requiring you to amortize it over 5 years. And on the tax credit side, it's been a very popular thing to get tax credits for research and development efforts. They've actually increased the tax credit from $250,000 up to $500,000, and it's a process to go through that. And sometimes we refer those out to specialists, but that was one of the things that recently changed. If you're familiar with this most recent legislation on the Inflation Reduction Act, there was a number of tax changes that took place, primarily related to solar panels, the batteries that power those solar, you know, it's optional, but those batteries that power the solar panels, that can be charged by the solar panels, EV cars, and then there's various energy efficient water pumps, heating pumps. There's a number of those types of items that are coming into play. Some of them are going to be for 2023, some of them are for 2022. But like say for instance on the solar tax credit, that was set to expire here in the next couple of years. The benefit was initially set for 30%. It has been slowly going down in percentage terms. So like if you got solar panels last year, I believe the tax credit max was 26%. They've restored it up to 30% now for 2022. So that was a big change and a very popular one. We've seen a lot of people get the solar credits. So that was something that was a big item that changed for the Inflation Reduction Act. And you guys are familiar with that, right? The act that was passed a few months ago. I'd like to go to the next slide though. And so I have a couple of comments on the personal tax planning opportunities here. And Don, if you have questions or if you want any elaboration as I go, please let me know, and please keep me on pace too if you need to.
Yeah, you know, absolutely. And I think before we even jump into this, I think your point is very sage. This is complex. Like there are a ton of things that exist, and business owners, I don't think they're sort of expected to, but I don't think it's a really fair expectation to become experts on the Internal Revenue Code, right? I mean, because at the end of the day, it's not about how much you make, it's about how much you keep. And one of the largest expenses that business owners have is to the federal and you know, in our case, not the state government, but in taxes. So with a lot of the business structures being pass-through entities, LLCs, S-corps, of the like, this really does turn into personal tax planning opportunities, right? It's something you're doing for the business, but it's ultimately the check that you stroke that's getting reduced. Your personal check that you're stroking to the government is getting smaller by implementing some of these strategies. Is that a fair point to make?
That's certainly the goal. Yeah, we want to try and find any opportunity we can to reduce your tax burden. But at the same time, you know, I don't know if it's appropriate. I'd like to keep this comment short. Maybe it's more appropriate for the Q&A at the end. There's like a battle between saving on taxes and having your valuation be as high as possible. And I've seen that over time. And I'm kind of going back to Brennan's last slide that he was commenting on deal killers. One of the items that I might have added to that list is having really strong financials. And so it's through the financials, having them accurate and timely, that we can look at this and say, okay, where's the business at? From a valuation perspective as well, but more from an operating perspective. We're in October. What does your year-to-date balance sheet look like? What does your year-to-date income statement look like? What do we have to work with here? We only have 2 months left to adjust your W-2s, max out your retirement contributions in some cases, take additional expenses to have them be applied for 2022. And I can tell you what the law is, but I need to know how it pertains to the business owner. And the best way for me to start is to have really good financials. By the way, that's what we do is in addition to income tax preparation. So I'm a little biased in that comment, but yeah, so there were some comments that I could say later that pertain to the valuation on why you should have strong financials. Make sure that, you know, we have everything in there though that we can see, so that way we can maximize, I want to say maximize net income, but maximize your deductions so we can reduce your expenses for tax liability.
Yeah, and speaking of deductions, I think one of the things on here that I think is really interesting, and if you can sort of talk to it a little bit, I think a lot of times when business owners think about their retirement plans, I think they're thinking of it from the perspective of like, okay, you know, I can deduct, you know, 20,000, whatever it is for myself, which, you know, if you make a couple $100,000 is not too exciting of a deduction, but, you know, it's good for my employees. Are there strategies or things that you see that potentially allow for business, the owners of the business or the executive team to defer more than just sort of this standard? We have 401k here, but are there strategies that you see that implement maybe some higher deductions they can take earmarked for retirement?
So with the retirement, the big, you know, there are a number of retirement plans that are available, as you guys are aware, the SEP plans, the defined benefit plans. Those, you know, those are typically, as you guys know, say for like 2021, the tax year obviously ended on December 31st months ago, but to some extent, you know, how it relates to the financial markets, we can take the deduction in 2021 but not fund the plan until September 2022. So it gives us some opportunity to leverage that cash in the way that we get the tax deduction, and then we don't have to fund it until later. Beyond that, you know, there's a couple of things that might not be so obvious, but I've seen happen here in the last couple of months, particularly since, say, April or May, but people are doing Roth IRA conversions. And it's a really good time to consider those. Now I'm talking about from a tax perspective, where if you have an IRA balance in a traditional IRA, you know, if you do nothing, years down the line, you go to retire, you take those distributions out of that traditional IRA, and those distributions are taxed as ordinary income. But what's happening right now is people are taking advantage of the market being depressed a bit, and they're converting those IRA balances into a Roth IRA. At the moment that they're coming out now, they're coming out at lower balances because the market's a bit depressed, and they're paying ordinary income tax right now in 2022 at those lower rates. As it moves into the Roth IRA, everything in there is going to grow tax-free. And later on, when you're drawing it out from retirement, all those distributions are going to come out free of tax. So I'm seeing that happen right now, and it's a popular thing to do as the market's depressed. You're paying a lower, in theory, assuming that the market bounces back over the next 30 years, which it should, or 10, 20, 30 years, you're paying a low tax on the distribution now, and then getting tax-free growth in the Roth IRA. So that's a big one. I've seen a lot of people do that for, many hundreds of thousands of dollars into, bigger numbers than that.
Yeah, no, I mean, I think that's probably the ideal scenario. When you take money out, you owe no taxes on it in the future. That's the best case scenario. So that's great that people are doing that. Donovan, if it's okay with you for the sake of time, I'm going to go forward to what I think is one of the most important things for especially architects and service-based industries to understand, and that's the 199A deduction.
Thank you. Yeah, that's what I want to go to also.
Yeah, if I can forward to that, just because I think this is, once again, something that sounds very complex, but if you work with a guy like Donovan who truly understands this stuff, you really realize it's not that complicated, but the savings is astronomical.
So yeah, that's the best way to put it. Well, I will say this: it is complicated. It is extremely complicated, and there's a ton of planning to go into this. And we've been doing it the last couple of years. I want to start by saying that there's a list of on the left-hand side of the slides there. There's a orange box and there's a green box, and the orange box says non-specified service, trade, or business. The one below it says specified service, trade, or business. There's a specific list of trades or businesses that are considered specified service, trade, or businesses. Accountants, lawyers, medical professionals, various service-oriented professionals are considered specified service, trade, or businesses. And if you're considered that, there's a ton of limitations. If you're making more than on the other darker orange slide in the top right, if you are making more than $207,000, $501 as a single filer, or as a married filing joint filer of more than $415,000, and you're a specified service, trade, or business, if you're over those amounts for taxable income, you do not qualify for what I'm about to say. So, by the way, how much time do I have, Don? Like 5 minutes?
Yeah, if we can do 5, because I want to just make sure we leave about 10, 15 minutes for questions.
Perfect. Okay. So what happened in the Tax and Cuts Jobs Act in 2018, the one I described earlier, they reduced C Corp taxes from 35% to 21%. But they didn't do anything for the pass-throughs, for the partnerships, the S Corps, the sole proprietors, Schedule C. So they came up with this as a way to make it fair. They said, okay, we gave a big break for the C Corps. Now for everybody else, there's this qualified business income deduction. That's what this section 199A is, qualified business income deduction. And so, so the reason why I was saying the specified service, trade, or business having a ton of limitations, I wanted to point that out first, so that way I could tell you that architects are specifically excluded from that definition. So they are not considered a specified service or trade business, which means that there's a ton of opportunity to strategize on this. And if you don't strategize, you are leaving money on the table, because this is a time-sensitive conversation. So let's look real quick at the boxes here. And so based on what I just noted, architects, we're going to pick them out for the purpose of this example, they're going to be on the line that says non-specified service, trade, or business. And so what that means is if you have a pass-through entity, if you're a partnership, if you're an S Corp, or even just a sole proprietor, I'm going to go over that first gray box there underneath the blue square. If you're at or below the taxable income, now this is at the individual's tax return level, single 157,500 or joint filers 315,000. If you're at or below that, then if you have, if your business is producing taxable income of $100,000, this qualified business income deduction will give you a 20% deduction. It shows up online on page 1 of your 1040. So you would get a $20,000 deduction with no questions asked at those income levels, and under the example that I had. There's now above those income levels, there's what's called a phase-in. And for those same categories, single from 157,000 up to 207,000, when you're in that gray area, or joint, you can see the numbers there. There is a 20% deduction, but it can be limited depending on how much W-2 wages you're paying, and that's a key thing there. So typically what I see is I don't see too many people hit that phase in area. I see them either, I see most companies in that farther right box where they're over the thresholds. Now, if you're over the thresholds, again, for taxable income of those amounts, single 207,000, joint 415,000. If you're a specified service trader business like me, I don't get any deduction. Lawyers don't get any deduction. Medical professionals don't get any deduction. This conversation is over with. But architects and other companies that don't fit that definition, where they're considered to be not a specified service trader business, what happens is that deduction is it's correlated to the amount of W-2 wages that you're paying. And so what we've seen, and what we're going to get ready to do here for a number of companies, for a number of our own clients, is we're going to look at, okay, where are we at for W-2s? Where are we going to be at for W-2 wages by the end of the year? What happens if we increase it by 20,000, by 50,000, by 100,000? What and there usually is an area where we max out the marginal benefit essentially by increasing the wages. So we try and find that sweet spot where we say, and this particularly works beautiful for solo owners, where all we're really doing is, you know, paying you out of one pocket, you're getting in the other pocket, but you're triggering this 20% deduction to the maximum. So we've had a few people last year where we were bonusing them $100,000, $200,000, and they were saving, you know, an additional $30,000 in income taxes, simply because of looking at this. But it's got to be done by the end of the year. It's not super difficult to lay this analysis in, but your books have to be, you know, your books have to be tight. I got to know where your W-2 wages are. And, you know, from a practical matter, we would like to see if we did a large bonus, you know, we want to see the cash available, which can be hard for sometimes. Not everybody has 200,000 in the bank to pay a W-2. But if it's going simply from you, if it's just an officer owner that you're paying on a W-2 basis, typically all we do is just pay the payroll taxes. It doesn't have to be a cash amount that's actually being transferred. We can reclassify distributions as wages, and there's a number of things that we can do to facilitate this.
Yeah, so incredibly powerful, and like you said, doesn't need to be complicated. You can be the one that deals with the complication, and the owners just get to save in taxes. Pretty cool thing. So really, what we wanted to do is make sure we left some time for if there's any specific questions, if there's anything that's top of mind. Like I said, you've got a wealth of knowledge here between myself, Brennan, and Donovan. If there's anything that you guys specifically want to ask, please feel free. Unmute yourself, chime in, or send a message if that works. But we want to make sure we leave time for questions. The other thing that we want to leave you with too, and I'll rehash this again, sort of gift for the group for attending. Brennan and myself would like to provide you with a free business valuation of where you currently stand. So if that's something that you're interested in, if you want to get a free business valuation, sort of see where you're at, then we'd be happy to do so, and we can coordinate with AIA and get that linked up and be able to help you guys out with that. So I'll open it up if there's any questions. Somebody's got to have something. Brave soul.
Do we need to unmute them?
I'm trying to unmute them as we do it. I have Samantha Haas has her hand raised. So where'd she go? Allow to talk.
Can't unmute ourselves and chat is disabled. We just got
I have her, she's muted herself. So Samantha, are you there?
Yes, I was just curious when the best time to start thinking about, succession and exit would be.
Brennan, you want to jump on that? You want me to take that?
No, I can handle it. I'm like Don had alluded to earlier in the presentation, the sooner the better, right? I would say that most effective plan timeline is kind of like at least 5 years. I think that's where you can really take advantage of the most and really get things dialed in the best that you can. I've seen them happen over 3 years or 4 years, but when you get under 5 years, it's just hard to really, let's say, implement systems and processes and different strategies to really grow the value that quickly. So I'd say 5 to 10 years is probably the best.
Awesome.
Feel free to elaborate if you have anything else.
No, that's a great answer. Sam, I hope that answered your question. Donovan, we got a question here. I think this one probably is in your wheelhouse. Does a manufacturer's agency qualify as a specified service, trade, or business?
So I'm not familiar with the manufacturer's agency. Is that I mean, a manufacturer, no. A manufacturer would not be considered a specified trade or business, but is the agency like some type of a service that's provided to manufacturers? Is that how I'm reading that? If you can elaborate. Manufacturers sales.
Manufacturers rep agency. We work with architects and designers in our community on projects.
Okay, no, I don't think that's the list is very short and specific. It's really it's as I said, it's medical, legal. There's actually insurance and some finance has been eliminated from that. Real estate is eliminated from that. They're specifically not listed as a service, specified service, trade, or business. But that particular manufacturer's rep agency is not one of the items that's on there. It's a pretty short list. People like that are selling their. You might see athletes on social media that are selling like they're promoting different types of products, and they might get a commission for that. There's some like branding from where you're using your image, your likeness, something like that's a specified service, trade, or business, but not the stuff that I'm seeing here right now. Not the manufacturer's rep agency.
Awesome. Lee, yes, there is going to be a link for this seminar that I believe AIA will send out to everyone. If I'm misspeaking, correct me.
No, you're correct.
Don, I actually like to comment on something with regards to the succession planning. May I do that real quick?
Absolutely.
So, Brennan, the things you said were great. I happen to have seen a few instances recently where there was unexpected passing of a solo owner. I mean, there's some it can get real complicated if the planning's not done. Jobs can be lost. The continuity of the business can be in jeopardy. And obviously something like that would demolish the value. So I cannot emphasize enough that there needs to be some planning to make sure that a successful transition is had. I saw one where there was a physician. He was a solo shareholder of his practice. He died unexpectedly, and his wife became the owner. She's not a licensed physician, and now the whole thing is in probate. So they're having to wait 6 months to get the clearance to sell this thing. And it's a disaster. I mean, it worked out okay for them, luckily, but that is probably the worst case scenario I've ever seen in my life. And it's it can be easily mitigated by getting some planning in place, while well in advance of something like that.
Yeah, that's a great point, Donovan. Brennan, you want to touch on that really quickly, as far as like a family recognizing the value of a business should that business owner not be there? What type of planning or contingencies go into sort of thinking about? Obviously, we don't like thinking about our own demise here, but what are some things that you've seen commonly that are used to sort of mitigate that threat?
Yeah, I mean, the biggest thing is having that succession plan in place. Especially medical practices based on what state you live in. There's states where, or it doesn't matter with medical practices. You guys are architects, so I won't even get into that. But like if you have specific professional designations, sometimes you can't even own that business if you don't have that designation or that training. So if your spouse doesn't have that and you pass away, they literally can't even run the business. So in that sort of situation, if you have no succession planning in place, like what do you think somebody's going to buy the business for if they know that nobody can even step in and run the business? So having that succession plan is huge, just kind of having the outline of what everything is going to be. And then obviously the rest would be made up between assets of a business owner and what they have. The business value would be included. And then, yeah, right there. Perfect. Dwayne,
33%.
let us know, only 33%. So that would be, life insurance can be part of that, obviously. Disability insurance and disability buyouts, those sorts of things. But yeah, I've Donovan, similar to you, I had a client in California who owned a solar company, doing extremely well, valued at north of $35 million. And the guy got in a car accident and can no longer run the company. And now he was that guy, right? He had they had a sales team and everything, but he was the guy that kind of did everything. The wife is in talks right now, negotiating, and it looks like it's going to sell for about $6 million. So,
yeah, and Brennan, that I'm so glad you brought up that point. We think of I think we go straight to a mortality. Like, what if the owner dies? What if the owner gets sick? What if the owner gets injured? What if the owner gets divorced? What if the owner goes to jail? Right? Like those sort of things. I think a lot of time people we're very good at imagining bad things happening to others. We're very bad at imagining bad things happening to us and ourselves. And if you have a partner, I will make this plug. If you have a partner or partners and you have not updated your operating agreement, your buy-sell agreement, I think a lot of times what we see is people go into business together at the beginning of the business's life cycle. And a lot of times we'll review operating agreements and buy-sell agreements, and they've got partners listed on there who don't even work there anymore. Or there's guys who are now partners who aren't mentioned in the operating agreement. So I think, Brennan, and correct me if I'm wrong, a lot of times that's a very natural starting point for sort of getting those processes and procedures in place is, hey, just take a look at the documents you currently have in place. Are they up to date? When's the last time you updated your operating agreement?
Yeah, I talked about a little bit earlier is business owners outgrow their planning very quickly because a lot of times they put the infrastructure in the very beginning to get it started. And then what do? They roll up their sleeves, nose to the grindstone, and they make stuff happen. And they never really go back and address that. And 5-10 years go by and their business is now drastically different with a completely different, unique set of circumstances that is not reflective at all of what it was the 10 years prior or 5 years prior.
Yeah, 100%. And I know we're wrapping up here on time. One more question for you, Brennan. Let's say I am an owner. Let's say I do. Hey, some of these things sound interesting. Some of these things sound like they might be applicable to me, but I don't really know. Where does this process start? What is the first tangible step that people can make as far as, does this stuff apply to me? Am I out of date? Like, what does that look like for an owner?
I would say getting organized. That's honestly and truly the first step. When I meet business owners and we start to go through their balance sheet and just building out their personal and business balance sheet, and you start asking it do you have a trust? Do you have they're like, yeah, I got one 5 years ago, or I got one. Yeah, we got one when we got married, or that kind of thing. Just simply getting organized so that you can see everything in one high level view, and then be able to start making determinations. And obviously, like we, you know, if our clients or prospects, when they first meet with us, that's what we're doing, right? We're kind of taking a look at, what do you have now? We kind of, hey, give us all your documents, you know, throw up all that information on us. We'll kind of organize it and put it all together for you. And then we'll come back with an assessment of like, hey, this is where you're at right now. This is the value of your company as it stands. This is what it looks like. And then here are, you know, where you have some opportunities and things look really great. And maybe this is where you have some shortfalls and things could go kind of ugly.
Yeah, that's awesome. We're right here on time. So I appreciate everyone, their time. Hopefully there was something in there that provided value to you guys, or something that you hadn't thought of before, or sort of maybe just sparked the fire of, hey, I need to get this stuff sort of taken care of. Be on the lookout. Like I said, we are offering complimentary business valuations. So be on the lookout for an email. We'll sort of show you what we need and who to get in touch with for that, as well as a recording for this link. So if there's anything that we went too fast on, or you want to go re-listen to, you know, look forward for that email as well, coming directly from AIA.
Thank you, everybody. Have a good afternoon.
Thank you.